I interviewed the up-and-coming trader and YouTuber Thomas Carvo. Thomas has been trading for over 7 years and shares his market knowledge and trading strategies on his YouTube channel, which is linked in the description below. In this interview, Thomas shares how he got started trading and walks through his go-to momentum strategy, which makes him consistent profits every single month. If that's not already enough value, he is also doing a free special giveaway to the OGT community. Thomas is giving away a free 3-month TradingView Pro subscription. A Pro subscription gives you ad-free charting, multiple indicators and layouts, and much, much more. If you'd like to enter this free giveaway, all you need to do is subscribe to my channel, subscribe to Thomas's channel, like this video, and comment down below your favorite trading indicator. All the details and links are down below in the description. Now let's get right into the interview with Thomas. Welcome, Thomas, to the OGT YouTube channel. How are you, sir?
Good. How are you? Thanks for having me.
All good here, thank you. No, I've given you a great intro, so really hoping that you can carry that forward and add some great value to the OGT community. It'd be great if you could just start with opening about yourself. How's your trading career gone? Yeah, I'll hand it over to your good self and let's go from there.
Awesome. Thanks. So I'm going to dive into those momentum patterns in just a bit and that giveaway. But first things first, I want to dive into really what got me into things. And currently, my name is Thomas Carvo. I'm 24 years old. I originally got into the markets back in like 2016. I guess I always had influence from probably my dad and so forth. But really, I got into it back in 2016 and blew all my money in options. And I was like, what is the stock market at that point in time? So that really got me interested because I was like, okay, I just lost all this money, but I was thinking on the flip side, there are people that are making, the money that I lost, someone essentially, making that money on the other side. So how do I get on the other side of these trades? How do I get myself in a position to leverage what I think is one of the most incredible resources out there? Because it's not like real estate. It's not like other investments where, you might have a lot more headaches and a lot more time commitments. You can really cater the stock market to whatever strategy you want. And so the freedom aspect, I think, is like the biggest piece because you can be anywhere, anytime, utilizing any strategy. And so back then, still young, really was probably late in high school or maybe just graduating high school at that time before I went off to college. And I went to Penn State. I ended up graduating Penn State in 2020, the peak of the pandemic, I guess. And so I never actually walked graduation because they didn't have them. But I graduated with a degree in meteorology, so forecasting the weather, but also I minored in energy business finance because I really had the ties to following financial markets and understanding. And I thought at the time that, I would utilize kind of this knowledge and my interest in the weather to kind of dive deeper into how that impacts financial markets and how that impacts maybe futures markets, commodities, things like that, which is really cool. And it is really kind of what got me into it, which happened to be a trading challenge back, I think it was my senior year of college. And we had to trade natural gas futures contracts. And so, of course, me starting to get into things and already being interested, I was like, oh, this is going to be cool. Like, everyone that were trading options, whatever, no one really knew what options were. As we're kind of going through class, like I kind of knew all this stuff and understanding the strike prices, how options are calculated and all that stuff, intrinsic value, right? We had all these things on exams and I was like, okay, this is easy. But when it came to actually trading the contracts, the futures contracts, natural gas futures, I had the worst performance in the entire class for the semester. And we had to get up at the end of the year and present kind of our results. And it was pretty awkward. It was, obviously it was not the most enjoyable experience to have to get up there and be like, well, I did the worst in the class. I lost however much money and I guess simulated money at the time. But that was another kind of one of those things that kickstarted me into kind of getting deeper into, understanding the markets and all that. And so fast forward, I guess not even fast forward, during that time was actually getting deeper into small caps. And so I kind of started off with options, lost all my money. And then, okay, like what about small caps? What about penny stocks? Let me see how, this stuff works. And I started to learn and dive deeper into that. And I had a really amazing, back then, being a college kid with student loans, I had essentially no money, part-time job, whatever. So I was able to take a couple $100s up to 50 something $1,000 in about a year and a half or so, which is insane. But that was, of course, on the back of the COVID market. And so things were going insane. It was very, I won't say easy to do, but you could essentially it made sense that was possible. And looking back, right, that's not the reality, but it was like, it was done, it's possible. And so that keeps kind of rekindling the fire of like, hey, there's still, so much more to uncover and so much more to discover and dive into when it comes to the market. So I get into small caps and I'm trading penny stocks. I was more of a swing. I wasn't day trading. I was more of a swing trader. So I would be looking for bottomed out penny stocks. I'd be looking for stocks that are down toward 52-week lows, offerings, post offerings. So you're looking for companies. These are not good companies. These are not good companies. You don't want to invest in these companies. So you think swing trading, that's got to be super risky. And looking back, like it totally was, right? I got caught in my fair share of offerings, second, third offering a company would do, which, is never a good sign if a company's doing that. But there were still opportunities. And so I was never shorting these companies, as that's almost, that really is extremely risky, especially from a swing trading approach. You don't know what's going to happen. There could be good news overnight and a stock could be up 1,000%, as we've seen, stocks can do, right? So I was like, what are all these big name stocks moving 2% a day? Screw that. I want to go and trade the stocks that are going to move 100% in a day and 200% sometimes in a day. And so that's why, that was the attraction to the small caps. The problem was that as I've kind of evolved, I realized that those markets are very cyclical. So you'll have good periods, right, where they can be very, very lucrative. And then you'll have periods where it's not going to be that easy, so to speak. So then I was thinking to myself, okay, this is great. Like I love this style, but I can't rely upon this style every single day, right? And so that kind of got me to where I am now, where I have a different approach of how I view the markets. I kind of view things in two ways. There's the investing approach, and you can be an active investor and be selling options and whatnot to cash flow your positions if you believe in a stock or you want to hold the stock, or if you want to just hold the S&P 500, buy SPY, the S&P 500 ETF, and you could be selling, covered calls or whatnot, or you can buy tons of different dividend ETFs as well, right? There's many ways to go about it. And that perspective, I want to try to keep as simple as possible, right? So I think about it as, okay, let's understand the macro situation here. And then, kind of drawing back on, what I got, some of what I was really studying in school and stuff. And so I do have a good feel for that. I took plenty of, macroeconomics classes, micro, all those classes were, at the time they weren't so fun, but they were, really interesting looking back. And now I can kind of see the application of all that stuff in the real world. So that's really cool. So I kind of have this macro view and manage my portfolio or manage some money around that macro view. And in the short term, what I'm looking at now is I'm really trying to build a system and a strategy that I can utilize on large caps and not small caps, because large caps will be there every single day. The markets, obviously they are cyclical, but there still moves up and down. And so I like the whole idea of looking at these things on a short-term momentum basis. And so removing myself from trying to guess where, Apple's going to go next week, next month, because I've got there, I've been there, done that, and I've gotten destroyed, right? That even comes back to the beginning. I remember I was essentially buying, calls on Snapchat before earnings. Little did I know, these options, it's not as easy as, oh, it goes up, I'm going to make money. Well, I had a situation where I, bought, I don't know how much money it was at the time. It's called $1,000. And when I'm, 18 years old, that's a decent amount of money. And so I put $1,000 on a Snapchat call for Friday when they had earnings on Thursday, and earnings come out Thursday afternoon. And I'm like, oh, the stock went up. Great. Friday, the day opens, and the contracts are worth nothing by the end of the day. And I'm like, how did this happen? Well, there's a lot more that you have to understand when it comes to those short-term, overnight, almost swing trades. And so I've been there, done that, and not a huge fan. I'm much more momentum focused when it comes to the short term and trying to predict what will happen next, almost, right? So big picture macro, understanding the macroeconomic cycle, where we're at, what makes the most sense, rates going up, rates going down, right? Maybe there's better opportunities in the bond market, right? Just buying bonds or, shorting, the bond market. There's other ways to play that based off what the Fed's been doing and where we are in the cycle. And then now it comes to the short term. So my goal right now is to build and create something that I can replicate day after day if I wanted to. It doesn't have to be every day. You don't have to trade every single day, obviously. But week after week, something you can rely upon and adapt to little changes in market conditions, but will be there. And that's where I jump into momentum trading. So what I want to do is I want to share my screen really quick. and dive on in to how we can kind of cover this and show you some examples.
So just quickly, just picking up on that. So you got your macro view, and am I assuming that you're kind of dollar cost averaging in every month into ETF, the big caps, etc. So you got your kind of macro view, just following trending out the market, which, will make you a decent return over time. Then you got your short-term momentum plays, which you're going to walk through with us, which are higher risk, but higher reward.
Yeah.
Is that kind of fair in terms of how you do your trading and investing approach?
Yeah. And a lot of, and now even so, especially when you're in more uncertain times, I find it that I don't want to have to worry. So I like to have as least or as small of individual stock exposure personally right now. And so that means, those ETFs. And so sometimes there's good income or dividend ETFs that they're paying right now. I think JEPI is a good example of one that pays around 11% dividend. Essentially, they're selling covered calls and holding, safer, I guess, investments, more like stocks in the Dow Jones. And something like that is easy for me to say, hey, I have an extra $100 this month. I'm going to toss it in there. I don't have to really worry too much about that. I'm not like, oh my gosh, what's earnings going to be for this stock, that stock. I don't have to think about that too much. Whereas momentum side, in a perfect world, right? If you have a system that's working very nicely and you're able to pull, let's just say a few percent on, a portfolio per week or whatever, it depends upon the time horizon, how much you're trading, all that stuff. It could be a lot more, could be a lot less. Then you can take some of those profits and then roll them in and help compound your longer term investments, that much faster.
So of your momentum trading, the profits you take, are you doing a percentage back into the kind of, the JEPI ETFs, for example, and then leaving the rest to compound your portfolio to place more trades in the future?
Yeah, that's the goal. Yeah. So let's dive on in. Okay, so here we go. Now what I want to do is I want to pull up a chart. This is IWM. It's the Russell 2000 ETF. It doesn't necessarily matter when we're looking at this momentum-based strategy, to be honest, what you're looking at and the time frame. Everyone's going to always ask, the time frame. What about the time frame, right? Is it fine on the 1 minute chart? I don't like to look at the 1 minute chart. There's a lot of noise, to be honest, when it comes to that. But when it comes to the bigger time frames, I always like to start on the 1 day or the 1 week time frame. And then I'll like to kind of zoom in. And when it comes to, let's say, a day trade, 5 minutes is usually as close as I'll go. Because I'm looking at more of a bigger picture pattern that will take, minutes to hours to play out, not necessarily seconds to minutes. That's the time frame that we're looking at here. And it can be catered to someone who is a scalper, as they say, who's in and out super fast. It's just not my style. So what this momentum strategy is, it is one of the best, in my opinion, when it comes to predicting the move. And so I think it builds really nicely off of, let's say, you're looking at a stock and you're like, okay, or even in this case, an ETF that's kind of a collection of stocks, and you want to get exposure to small cap companies because you believe that, hey, in the next couple of months, let's say your macro picture is that, the Fed's going to be cutting rates and whatnot, and there should be a nice tailwind for, higher risk companies and some of these growth companies that maybe have been down a lot over the past, couple of years or a year or so, and there could be a nice tailwind and you want to play that momentum. Well, how do you confirm that thesis or that idea? And how do you confirm that and get yourself into that sort of trade? Well, we can utilize this strategy. So generally speaking, I'll start off and I'll look at a chart, okay? And I'll get a good feel for, what I'm looking at and how I view things. Let me just change the candlesticks to regular candles so it's a little bit easier to see the greens and the reds. But first things first, obviously I want to see higher lows. So, and this will again cater to the exact opposite when we're downtrending. So it doesn't matter if it's up or down. It can be played both ways. I want to see higher lows. So in this chart, right, we're seeing that IWM, as of late, we've got higher lows. Great. So momentum is up. If we wanted to play this on the downside, or let's say, we wanted to buy this and we were looking at maybe a better fundamental buy that we think, is somewhere down here, or we think that it needs to go lower, that's fine. Problem is that if we want to trade based off of, a longer term macro picture, that's where I've gotten into the most trouble. When you have this thesis, you have this bias that's, oh my gosh, we need to go lower on all these stocks, or the market needs to go lower. We haven't found a bottom yet. But the charts tell you one thing, you'll find yourself many times losing money. And I have been there. I have done that while stocks are going straight down, right? And I'm buying options, or I'm buying positions out a week or 2 weeks or, a month, trying to time the bounce, which eventually it comes, as we've seen some really nice bounces here. right? But if you're just buying randomly in here, it could take, a lot longer. And generally speaking, it takes a lot longer than you think for the bounce to come when you're on the wrong side or when you're fighting the direction. So what we're looking for is a nice continuous move up. And then what we want to see is a higher low being built. And so right now, for example, we see IWM. We've got a higher low right here, right? So we had a big push up. We hit a new relative high on the year. If you go back a few months, really, we've had a new high compared to, you got to go back all the way to August in this time frame, which is a long time ago. So we've hit a new high over the past couple of months, not to that August high just yet, but we at least have made a very nice push over some of the recent highs that we saw right here. So momentum's up, great. We got a higher low. This higher low, what we want to see is if this higher low ends up bouncing or ends up establishing on some prior areas that we couldn't get above, as we call resistance. And so what I'll do is I'll draw a nice little box in here. And so what I want to do is I want to draw a box that covers these highs and the recent low. If that's the case, if this recent low is essentially sitting on top of recent highs, you go back on the chart, you've got a high right here, you've got one here, and then you've got another here. So that's three. That's three recent highs that we couldn't break above. We eventually did, and now as we come back, we're back testing that. And so in this case, we've got really nice momentum. We've got resistance now turning into support. We've got higher lows. We've got a really solid move to the upside. The next piece to this kind of strategy is, okay, do we have volume to support this price action? So when I say volume, on these big moves up, we want to see nice higher volume, right? So if we're seeing a big move up, but we're seeing low volume, that's telling us that there's not many buyers here. It's kind of just slowly going up, but there's not a ton of confirmation behind this type of move. And so in this case, what do we see? Well, we actually see volume that's been increasing as of late. And then even on this push right here to break up over these highs over this white box, what do we see? Higher volume. So we've got these higher volume pushes to the upside. And then as we pull back on those red candles, what do we see? Generally speaking, in terms of relative volume, it's actually lower. So this is telling us that as the selling pressure is not as strong as the buying pressure. The buying pressure and the buyers have it under control for now. That can change. There could be news. Anything can happen, right? That's the stock market. Anything can happen anytime. But what we want to look at is when we start to see a stock that's building a base on a prior area that was resistance, that was rejecting, with the volume to support that move, this is what we're looking at for continuation. So what I like to do for plays like this is, if you wanted to, in this case, we're looking at the 1 year, 1 day. This could be a valid swing trade right now in this case, because we're looking at, a bigger time frame, of course. When you're looking at swing trades, whether it's just buying shares, maybe buying 3x ETFs, that's one way to do it, in my opinion. When it comes to trading, if you're trading like, let's say, the S&P or the Russell or whatever, instead of playing the option game, which there's time decay, there's a lot of ways you can lose, or they could be expensive if you want to buy plenty of time. It could be expensive. There's 3x ETF. So you can buy, a 3x bullish ETF for IWM or 3x bearish ETF for IWM or SPY or QQQ. And so those are great ways to get a little more leverage and be able to essentially get in and out in the pre-market or after hours if there's some terrible news that might change everything and no longer, allow this thesis or this setup to be valid. So once we break down below this low right here that was now established, this higher low, this is going to invalidate my idea. I'm not trying to time this. In a perfect world, or not in the perfect world, in the past, I would be the type of person that says, okay, get rid of this, or let's say I didn't enter this trade just yet. We come up, we start coming down. I'm going to buy right now. But what do I have? I have no confirmation that we've actually bounced or that we are establishing a higher low here in this zone. Yeah, I'm anticipating that, yes, and sometimes I'll be right. But I've found that once you wait for that confirmation, that bounce, that's going to be the best place to then enter a trade. And then now your risk is underneath that recent bounce. So for example, on this trade, I'll use one of TradingView's trade indicators. If I took a position right now, okay, my stop loss is below here. I like to look for a 2-to-1 risk reward. So what does that mean? It means that I am going to risk $1 to make $2 on this trade. So that would mean that I'm targeting at the top of this green zone and my stop loss is underneath this higher low. So that's a great example of IWM and playing the Russell to the upside. What about the downside? Because everyone's like, okay, well, this is great in a bull market. What about the downside? Might not be as easy to see. But the same exact concept applies, just flipped. Okay, so let's jump over and check out, I think it was Microsoft, MSFT. from this past week. Now I'm going to go into a shorter time frame. So check this out. So I go to the 30-minute chart. Now, on the 30-minute chart, what do we see on Microsoft? We see this thing as of late, it's getting up into here and it's rejecting. It's not able to break up over this level, a bunch of highs, it can't get there. So it starts to trend down. Do I want to immediately take a position on the way down? I could, and that's, again, it's sort of a guess, but I don't necessarily have the best or the highest conviction for this trade. So I want to see Microsoft is I want to see it start to break down. I want to see it start to bounce and then reject, bounce and reject. And we actually see that happen a couple of times. So you have this move down here, it bounces, next day moves down again. Then when we come to a pattern or a situation like this, we also like to look for consolidation. So Microsoft, what we can see right now is this bounced right here. So we have a higher low, or we had a lower low right relative to this area right here on Microsoft. So we bounced, we broke below that. And now what I'm looking for is that level to become an area that we can't get above. So if I draw in, let's draw in a line right here. Let me get rid of those levels. If I draw a line right here, you can draw at the wick low, or if we have a collection of lows, essentially the same thing. I like to use areas, to be honest, because one simple line is in the stock market is just, you're asking for trouble, and it's not going to be easy to determine, because when you look at one simple little line, we can break above it for a second or two and then right below, or vice versa, and it's going to be very easy to get thrown off. So I like to use areas, and some will call it supply and demand trading. And generally speaking, I like to give it, in every stock is going to be different. I wish there was a, one answer or one fits all answer. Oh, just use, a $1 range on your zone. It depends. I like to say maybe a 0.5% type of range. So if we look at like a Microsoft, and every stock, if you have a more volatile stock, you might want to use a bigger range. Like Tesla's more volatile, maybe a 1 to 2% range might make a lot more sense for drawing your zones. But for example, we have this low of this candle right here. If we use a 0.5% range, that's about this large of a box. Let me see if I can draw that box in to make it a little more visual. So that's this is the size box. Even that's kind of large, but generally speaking, this will generally work, right? So what we're looking at now is I draw this zone to about a 0.5%, give or take. And what I want to see is, hey, if we come down, we start to reject, right? We're coming down and we hold support here. We hold here, we bounce. Great. Now we get below that level. If we break down below that, okay, we're breaking that, right? We are now establishing momentum to the downside. Okay. Can we test that? And what happens if we do? So guess what we did? We came up into this box. We tested that area that acted as a nice support bounce, and now it's resistance. So now you kind of see this on a short-term time scale. I think that IWM example was very nice and visual. Now we can see it playing out on the different time scales. And so this could be more of a day trade setup. We see that Microsoft rejects here. We have a candle that comes up. Do you immediately go short there? No, because you don't know if it's going to blast right on through. It could easily blast right through. So now we go in and we see this happen, and we see, okay, Microsoft's rejecting. This candle is not able, or the price action is not able to get above this 266.70 area. As that occurs, now I can enter my trade. Once that big candle occurs, do I care exactly my perfect entry? No, because we're looking at this bigger picture. And if I go for a 2-to-1 risk reward, let's say I got in somewhere in here, right? My stop loss is above that candle high. We had a close attempt to test it right here, shortly after, later in the day, about an hour or two later, but it ended up being a lower high and establishing continuation momentum to the downside. And then that 2-to-1 risk reward profile, so it's depending upon our entry point, that 2-to-1 risk reward is right here. We would have taken profits nicely into the close on that day as Microsoft smashes through that take profits. That's a really good example of looking at it on the shorter term timescales. Again, it's not as clean, but I think it's very useful to kind of apply this to both the upside and the downside. Now, if you want to go to even shorter term and you want to talk about a stock like, for example, Affirm. Affirm is a stock that I was watching this past week, and I actually took this trade and it worked out very, very nice. So the same kind of concept applies, right? So Affirm makes a big push up. We've got higher lows. It's trading higher. This white line is the VWAP. I can get rid of the VWAP for now because it's not necessarily important to this example, because we're looking just at price action right here. So if I get rid of the VWAP and we look at Affirm right here, makes a big push off the morning, right? Open stock market opens up, it pushes higher. Each of these kind of windows between the different shadings is 1 day of regular trading hours. And so we got this big push up. Here we have this high that we seemingly reject off of and come down. Now we start to inch higher, eventually blast through that high. Cool. a firm blast through that high. Now I'm saying to myself, okay, cool. Will it now show that that prior high is now an area of support? If it can, that's a great sign of momentum and upside, right? Potential further upside. So what does a firm do? A firm consolidates nicely right here for about, looks like a half hour or so. Each of these candlesticks is now 5 minutes. Consolidates nicely. Then what it does is it comes down and it tests that exact, pretty much almost to the cent, that exact same prior high, holds it as now a higher low. And now what a firm does is it blasts through with, right here, look at this, volume. Very nice, solid, big volume candle. That's what you want to see. So obviously, when you see this happen and play out, it's a lot easier to come back in hindsight and say, oh, this is a great setup. But what we're looking for is essentially the big volume off the open, the big green candles. Now, of course, right, we see the volume generally fades out as the day goes on. You get to midday, lunch hours, etc. Right? So that's generally what happens. But we're looking at a relative scale. So we see that volume is generally trending down. But what do we see? What are the biggest volume candles here? They're all green. They're all on big pushes up. So we've got buyers and we've got sellers now essentially losing to these buyers, and buyers are being able to push through. And so that tells me we've got momentum. We've got price action that is moving in the upward direction. And that if I was going to take a bet, there are now signs, a stock that's now holding a prior resistance as support. We've got very nice volume on those green candles as we're moving up. That's where the higher volume is. This is telling me that there's a higher probability that this stock continues going up than going down. Now, it's very easy to get caught up in, oh, it keeps going. How do I know when it's over? The problem is that this setup is great when we have great momentum early in the day, but as you get to that midday time frame, as volume dies out, as we can see, the volume is really, really low right here. The setup has a lower and lower probability as the day goes on. Looking back, it actually worked yet again, but would this have been a great high probability trade in my opinion? Not necessarily, because what we had was you would have had to wait for hours for this to play out, for the move up. Now you could play options, you could play shares, there's a lot of ways to do it, but the higher probability is early in the day or at the end of the day, power. That last 1 hour of trading is power hour, a lot more volume, as we can see, comes into the market. And so if the setup is still valid late in the day, great, then it's an opportunity. But you want to avoid that midday, that couple hours in the middle of the day after the first 2 to 3 hours once the market is opened. You want to avoid that, in my opinion. I've just seen that the probabilities are going to line up much more in your favor earlier in the day as the setup plays out. Now, the more times you see this setup, the more times you see it, the lower the likelihood. In this case, it worked out again right here, right? These prior highs acted as resistance. We got above that on nice high volume, great. Then we consolidate on very low volume. You just consolidate. Then some higher volume pushes come in and we pop through. Great, it worked out. But I've seen many times the second or the third, the fourth time this setup plays out during the day, the lower the likelihood that this is going to work out in your favor. So I know it was a lot. I know it's somewhat very technical, but I try to keep it as simple as possible in terms of what to look for, right? Like the keys you're looking for is a prior resistance or support level, a prior high, right? A swing high or swing low, as some will call it, right? Looking for a candlestick to push up or push down, establish a level, and then pull back, consolidate, break through that. Now we're looking for that prior area that we had a swing high or swing low to establish support and resistance. In this case, on the move up, it establishes support right here. And then we're looking for continuation higher. And our risk is quite simple. It really does not have to be very difficult. It does not have to be, oh my gosh, I have to use all these EMAs and all these VWAP lines. Like, it could be as simple as price action. If we break down below this level that we established a higher low, that's my stop loss. I'm going to get out. I'm going to look for a 2-to-1. You'll sometimes get much more than 2-to-1 risk reward on these types of trades if your entries are really dialed in. But in my experience, a simple 2-to-1 makes it easy. And then as long as you're right half the time, you got a profitable strategy. So you don't have to be right every single time. But using things like the volume and the price action like this is going to put you on the plus side of that probability, in my experience. So hope that makes sense. And then hope, your audience can take something away from this if they're interested in diving into momentum. But I think it's a great application, to be honest, on the larger time frames, because on the larger time frames, you're looking at a stock or momentum, let's say on the overall market, you don't want to fight that sometimes. Well, you might have a bias and you might have a belief this stock is worth this or that. If momentum is up, then maybe it's not the best idea to start initiating put positions or initiating shorts, or even maybe selling out of your current long, because it's continuing. We've got continuation. There's no signs of stopping. So hope that makes some sense.
No, absolutely fantastic, Thomas. And, like you said, you don't want to fight momentum, don't want to fight the trend, even though you might have a bullish or bearish overall stance, but depending on the time frame you're looking at as well. No, exactly. I just had a quick question is, how do you find these stocks?
To be honest, I actually don't now. Looking back, there are patterns, and bull flag patterns is what they're generally called, or bear flag patterns is the general idea of these patterns. And they all kind of have their varying degrees of how they look, but I have a collection of a list, really. So in terms of large caps, I can actually pull it up too, because I think it's easy to kind of share. In terms of large caps, I like to keep it as simple as a list of maybe 10, 20 stocks. So here's my watch list. So I can bring this across so you can see it a little better. So here's my main watch list. I kind of have my ETFs. I have, let's see if I can expand this. Some large cap stocks, Teslas, Apples, the stocks that I've seen that have the most volume, that move the most, and that a lot of people are following. So I'll have that list. And then as time goes on, I have just discovered these stocks, whether it was, watching them intraday with some big moves, seeing them make big moves over the course of days, weeks, or months in the news cycles. And I just kind of built a list of stocks that I am familiar with and that kind of cover different sectors. So I have this risk on list. And so when we have a risk on day, you'll see stocks like Affirm, Coinbase, SQ, Upstart, Rivian, even Palantir, Roblox. Like, these stocks can go 10, 20% up and down. So these are like crazy high momentum stocks. And so I just want stuff that moves. That's all I'm looking for. Stocks that are maybe generally, in the Dow don't move as much as stocks that you'll see, for example, in the NASDAQ. And so I want to have stocks that move. And so I built my list out, and I would recommend, to be honest, keep it as small as possible, so that you're just looking at a couple stocks, you're familiar with these stocks, and when you see the pattern play out, great. You now have a reason to take a trade, because you can find this pattern on a million stocks. It's always there. It's always going to be there. But as you jump into this one and that one and this one, you're not familiar with their moves. And so the more familiar with the moves you are, the better. And so that's what I would recommend. And start small. Maybe start with your Teslas, your Apples, your Amazons. Maybe throw on a couple of those stocks like a Coinbase or an Upstart or Shopify, Rivian in there, that are kind of those higher risk, higher reward type of situation, or those types of stocks. And then once you kind of build from there, you'll kind of see what you like. You'll, as time goes on, you'll hear a stock here, you'll hear a stock there, and you'll put it on your list. And from there, you can kind of take it little by little. And I would recommend, I found the more you have here, the more complicated your list, the more your head's going to be jumping around. You're going to be looking for different things, and you're not going to be focused on that specific type of setup and watching for that momentum.
So anyone that's interested, make sure you subscribe to Thomas's YouTube channel and check out his videos on his momentum pattern, which is absolutely fantastic. And if you could send me a couple of links of like videos that you would recommend that the audience watches next, I can put that in the description as well.
For sure.
Perfect. So what I want to quickly do is, I don't want to forget about this giveaway. So Thomas has been very supportive of the YouTube channel. He wanted to provide as much value. He's already given tons of value already in this video, but he wanted to give you some more value by giving a subscriber of this YouTube channel a free 3-month pro subscription to TradingView. To participate in this particular one is, I want you to, more than likely you're already a subscriber of the OGT YouTube channel, but if you are not, please subscribe to this channel. Head over to Thomas's YouTube channel, subscribe to his, like this video. And what we want you to do is, we want you to comment down below and just tell us what your top indicator is. It could be as basic as the RSI. It could be one of my OGT indicators. It doesn't matter which indicator it is. We're really interested in understanding what types of indicators people are using. And if you could comment on this video what your favorite indicator is, and what myself and Thomas will do, we'll take all the people that have valid entry into this promo, we'll stick it into a random generator, and then we will reveal either through a video we'll do together or on our community post, and reach out to the individual that has won that probably in about 20, 30 days time.
I'm looking forward to it. And I also want to comes to TradingView, there's the paper trading platform there. So you can trade this for free without having to risk your own money and try things out and see what you like. And if it doesn't seem to work this way, you can always make those adjustments. That's one of the biggest things that I have learned over the years is, you learn from somebody and then you make your adjustments that fits your style and fits how you see it. And then you can make those corrections and you're all good to go. So I just want to say thanks again, Zoab, for having me. I appreciate you and the One Glance Trader community.
Appreciate it.
And
thank you.
something like this again in the future.